Hello, I'm your host, David Klink, Director of Credit Research at Meter Public Funds. Today, I want to walk through what we're seeing in the investment grade credit market and where we think financial professionals should be paying the most attention as we head into 2026. I'll start with spreads. Investment grade credit spreads, which are simply the extra yield investors earn over U.S. Treasuries for taking corporate credit risk, remain near historical lows. In other words, investors are not being compensated very much for owning corporate bonds instead of government bonds that are theoretically risk free. That has led to a lot of commentary suggesting the market is overvalued. While that concern is understandable, it's still not clear what the catalyst would be for a meaningful widening in spreads from here. When we look at corporate fundamentals, both for non financial companies and for banks, they remain very strong. Recent earnings reports have been broadly positive, with stable revenues, solid margins, and healthy balance sheets. So, while valuations look full, the underlying credit picture does not look fragile. Turning to investor demand, flows into investment grade credit markets have been strong throughout 2025, and we expect that trend to continue into 2026. A big reason is behavioral. Investors spent much of the last decade earning very little income in fixed income markets. Now, with yields in the 4% range, even high quality bonds are offering what feels like meaningful income again. That matters because at today's spread levels, future portfolio returns are less likely to come from bonds rising in price due to credit spreads tightening further. Instead, returns are much more likely to come simply from carry, where the bonds yield when held to maturity. And that carry provides a meaningful margin of safety. With yields around 4%, the market's expectation for a couple of rate cuts over the next year would have to be completely wrong and replaced by several rate hikes to overwhelm that income in a shorter duration portfolio and produce negative returns. So we see that solid yields will likely support fund flows going forward, no matter what happens to the pricing of credit risk itself. Turning to fundamentals, the story remains constructive. Corporate debt levels are in line with, or even slightly below, recent historical averages. Bank capital ratios are strong, and the leverage levels remain low. Credit metrics like non-performing loan levels remain solid. We also continue to run frequent stress tests on our approved issuers, and the results are reassuring. It would take a fairly severe downside scenario to cause even modest pressure on credit ratings. In most reasonable stress cases, the impact would show up in lower profitability rather than balance sheet deterioration. Now let's talk about supply, or issuance. Overall issuance in the investment grade market remains steady. Much of that issuance comes from non-financial companies and has gone to fund mergers and acquisitions or the very large deals coming from tech hyperscalers racing to invest in artificial intelligence. Bank issuance, by contrast, has been relatively low. That's because banks are sitting on very strong balance sheets and are experiencing low credit losses. And when banks do issue debt, it's mostly traditional senior unsecured bonds, reflecting the fact that they've already filled out their required regulatory capital buckets. Looking ahead to 2026, we expect these patterns to roughly continue. Likely a bit more issuance from non-financial companies pursuing M&A opportunities, and less from financials, which simply don't need to issue much given all their excess capital, especially as regulatory requirements like the supplementary leverage ratio look to be gradually eased. So the market looks healthy right now. That said, there are still important questions. One is whether inflation will remain subdued, providing room for further rate cuts. These rate cuts have generally improved the credit of borrowers. Is this in jeopardy of a reversal? Another question is whether future policy rate cuts will meaningfully lower medium or long-term borrowing costs. There are growing concerns globally about sovereign debt levels and fiscal sustainability, and those concerns may keep longer-term yields elevated even if near-term policy rates come down. We also wonder if the consumer will continue the strength of the post-COVID period, or if higher cost of living dynamics or tariffs will weigh going forward. Viewed another way, are the continual news articles on what's being called a K-shaped economy a warning light? Finally, M&A markets are very strong right now. Is that a contrarian indicator? Financial history is full of examples of large M&A deals that indicated over-optimism in the economy. Are we nearing that stage? Simply seeing large numbers of big deals isn't necessarily a sign to rush for the exits. So, with all that in mind, we remain cautiously optimistic entering 2026 in the investment grade credit markets. I hope you have found this segment informative. Thanks for watching. If you have any questions or want to chat more about anything we've covered, feel free to reach out to our team. Thank you for your time and the trust you have placed with Meter Public Funds.